Hello, I'm Yutaka Watanabe, a tax accountant. Welcome to the channel Tax Accountant that solves your money problems. Today, I'd like to talk about what are the key points to watch in the Japan-China tax treaty. When doing business across borders, one unavoidable issue is the role of taxation. Tax treaties, when used effectively, can provide companies with extremely attractive financial benefits. In other words, guaranteed advantages. However, hidden behind those benefits is the harsh reality of strict compliance requirements and serious potential pitfalls. Today, let's clearly organize these issues and uncover the data structures that are often overlooked when people only have a superficial understanding of the treaty. Let's begin with the core question. In the end, what exactly are the important points to watch in the Japan-China tax treaty? This is not merely a legal question. For every company currently doing business in China or planning to do so in the future, this is truly a matter of corporate survival directly tied to profits. If you do not understand these rules, not only could you lose benefits that should have been available to you, but you could also face unexpected penalties. So, what exactly does that mean? Let's break it down step by step. Section 1. The benefits of reduced tax rates. Let's begin with the advantage available through withholding tax reduction. The most attractive feature of the Japan-China tax treaty is undoubtedly the reduced withholding tax rates. In other words, the ability to lower taxes in the country where the income arises. Specifically, these benefits apply to three major categories: dividends, interest, and royalties. For example, this includes situations where profits are remitted from a Chinese subsidiary back to Japan as dividends, where interest is received on money rate, or where royalty payments are received for technology or patent license. When moving these kind of funds, essentially the lifeblood of business, the taxes withheld at source can be significantly reduced. This directly impacts the final amount of profit remaining in hand, making it an extremely important issue. How effectively a company utilizes these reduced tax rates becomes a key element of its global financial strategy. However, this is where international taxation becomes frightening. The story does not end happily just because reduced tax rates exist. Now, let's examine the reality hidden behind these attractive benefits. Section 2. Strict beneficial ownership determinations. This concerns evaluations under Chinese domestic law. One abstractly critical point is the process known as the beneficial ownership determination. Under Chinese domestic law, tax authorities conduct extremely strict examination to determine who the true owner of the income actually is. Superficial arrangements such as we established a company in Hong Kong. So please give us the truly benefits will never be accepted. Authorities carefully investigate whether the company truly controls the funds, whether it genuinely enjoys the economic benefits, and whether real business substance actually exists. The scrutiny is so severe that it feels as though every corner is being examined with a magnifying glass. They review the situation, the existence of employees, and the company's decision-making process. No matter how perfect the documents may appear, the sharp eyes of tax authorities looking for the true substance cannot easily be deceived. So, what happens if a company fails the strict test? That leads us to the next issue. Section 3. The risk of being treated as a paper company. This concerns the denial of treaty benefits. If, after the strict review, the company is recognized as the true beneficial owner with sufficient substance, then congratulations, the treaty benefits apply and the reduced tax rates can be enjoyed. However, if the company is said to be a paper company lacking real substance, the treaty benefits themselves may be completely denied. In other words, the reduced tax rates disappear entirely. Instead, the full domestic tax rates, which can be extremely heavy, may suddenly be imposed. This is not merely a situation where taxes become slightly higher. The risk is an extreme or nothing scenario. Furthermore, if substance is denied, there is also the possibility of enhanced retroactive tax assessments covering prior years. A single determination would completely overturn years of Chinese business running and profit forecasts. This is an absolutely crucial point that companies must never forget. And the risks do not apply only to corporations. There are also risks for individuals. Section 4. Tax exemption rules or short-term visas are one about different from other countries. This section is especially important for HR and labor management personnel when discussing the taxation of short-term business travelers. Assumptions such as it should be similar to treaties with other countries or the usual 183-day rule should apply can be extremely dangerous. Under the Japan-Chinese tax treaty, there are cases where China provides its own unique interpretations and operational practices regarding their counting method and specific conditions. For example, even slight differences in how entry dates and departure dates are counted can suddenly create unexpected tax risks. Rather than relying on generalized assumptions such as it's probably about the same, companies must carefully understand the differences between countries and handle each case individually and cautiously. Up to this point, we have examined both the natural advantage of the China tax treaty and the hard the arguments behind them, including strict beneficial ownership determination and unique exemption rules. Finally, let me ask you a question. Does your company's current business structure and internal form of funds really have enough substance to withstand China's extremely strict beneficial ownership examination? Or are the really benefits that you naturally assume you will receive actually exposed at this very moment to the risk of being denied as a paper company arrangements? I strongly encourage you to use today's discussion as an opportunity to carefully re-examine your company's compliance framework and international tax strategy. Today, I spoke on the topic, what are the key points in the China tax treaty. For more information about international taxation, please also visit the website of the Utaka Tax Accountant Office. We will continue discussing topics related to the money in the future. So please subscribe to the channel Tax Accountant Now. Solve your money problem.